Now I'd like to introduce Dan Satterfield, Chief Financial Officer, and Alex Trapp, Chief Strategy Officer of StandardAero. StandardAero is the largest independent provider of aerospace engine aftermarket services for fixed and rotary wing aircraft across commercial, military, and business aviation markets, offering solutions such as engine maintenance, repair and overhaul, and component repair, field service, support, asset management, and engineering. Its two segments are engine services, which provides engine and airframe maintenance, repair and overhaul, and component repair services, which supports aerospace, defense, and other industries with piece part repair, accessory repair, and new part manufacturing. StandardAero has 334 million shares outstanding for a market cap of about $9 billion with about $2 billion in net debt.
Good morning, I'm Dan Satterfield, CFO of StandardAero. We'll walk through a few key highlights of the company and we'll get to questions. So StandardAero is the leading independent aero engine aftermarket services provider. We have a pure play focus on the aerospace engine aftermarket. 80% of our revenues come from platforms where we have either the number 1 or number 2 position. And importantly, 77% of our revenue comes with customers with long-term agreements, providing great visibility into long-term revenue opportunities. We're organized into 2 segments, engine repair and overhaul and component repair services. These 2 segments have great synergies with each other, which we'll get into later. And we're a key partner to both the OEMs, decades-long relationships with the OEMs, and with the operators. We have a pure play focus on the engine aftermarket. Within the $111 billion aerospace aftermarket, engines represent 48%, and that's where we play. We have a strong presence within the aftermarket. It is the most profitable, highest growth, most regulated, and has the highest barriers to entry within the aerospace aftermarket, and that's the engine side of the aftermarket. The long-term tailwinds include well-known pent-up demand, also constrained capacity, an aging global fleet, and greater outsourcing, all good signals for StandardAero. We sit at a very important critical partnership role between the OEMs and the operators and customers. On the OE side, our independent position allows them to focus on developing engines. The aerospace engine manufacturers are focused on developing new engines and selling aftermarket parts into the channel. Also, our independent position as the MRO operator allows the OEMs to expand their aftermarket support network. On the operator side, our independence offers creative and customized solutions for customers, as well as superior attention, service, and performance, providing bespoke maintenance solutions for each customer. We have leading positions on most of our platforms served. This is a great chart of the broad presence across our platforms in various stages of their life cycle, representing both new generation, midlife, and legacy engine platforms. Within the commercial turbofan platforms, we have strong positions on the narrow body, the most heavily flown aircraft in the fleets. In particular, CFM 56, LEAP, RB211, and CF34, the regional aircraft engine. Within our turboprop suite of engines, we have strong number 1 or number 2 positions in these early to midlife stage engines with dozens of customers across a variety of end markets. Within military, we have strong positions on the fixed wing transport aircraft. These are the workhorses of the military, in particular the Air Force, the C-130 and the V-22 Osprey, which is the transport aircraft for the Marine Corps. Also the J-85, the engine that powers the Air Force trainer aircraft that trains new pilots to fly jet aircraft. Within business aviation, fantastic positions on the HTF 7000 and TFE 731. This is a pitch and catch position where the TFE 731 is now a legacy engine and being replaced by the HTF 7000, where StandardAero has the exclusive license from Honeywell to do heavy maintenance overhaul work. We have a strategically located global footprint with 50 facilities globally and, importantly, 55 global test cells, one of the highest barriers of entry into the aerospace MRO market. Test cells are very expensive to build and take years to develop and design and put in place. StandardAero has 55 of these. Although we have strong North American presence as well as in Europe and Asia, our sales force is global, and we have a local service. Aircraft engines in the narrow body, turboprop, military, and business aviation are easily transported to our facilities around the world. Onto our component repair business segment. We love this segment today. About 28.7% margins as of the first half of 2025, and we have guided on August 13th to revenue of about $725 million annually. We believe if this business were to stand alone by itself, it would be one of the largest component repair businesses in the world. Importantly, it has 20,000 unique certified repairs from the OEs. These repairs offer the opportunity for parts to be repaired as opposed to paying a significant premium for a new part, as well as longer wait times for a new part. And the synergistic relationship with the engine services business within StandardAero is important. Component repair services is providing an ever larger service solutions for the engine side of the business with our insourcing effort, with more repairs being done internally at cost. This is a large growing market, a very fragmented market, where we are the consolidator of many businesses and building up to our unique repair portfolio, and it also provides very interesting pricing opportunities. We have a track record of successful M&A, 11 acquisitions since 2017, growing the company significantly in capability, platform served, and capacity. And by the way, we're quite good at this. Recent acquisitions have lowered our multiples, acquired multiples by half. The recent examples being Vector and Dallas Aeromotive, plus significant additions to our component repair service business, most recently last year, Aero Turbine, which is not only a great component repair business, but it also serves the military end market. We had a great second quarter and first half with strong revenue and earnings performance, 2 beat and raise quarters, and strong growth across our diverse end markets. Commercial aerospace up 14%, military and helicopters up 12%, and business aviation up 9%. Our strategic priorities for 2025 are in great position. Importantly, our LEAP industrialization at San Antonio, LEAP revenues have grown 3 times quarter over quarter in the second quarter. We now have $1.5 billion of LEAP wins to date, and our long-term outlook is even more robust. Within organic investments, our CFM56 Dallas-Fort Worth facility opened last year is now doubled our capacity on this important and largest engine program in the world. CFM wins continue, and we've just recently, last week, cut the ribbon on an 80,000 square foot expansion of our Augusta business aviation facility. CRS expansion remains a strategic priority for StandardAero, and we had a record margin in the quarter, 29% EBITDA margins for CRS in Q2. New repair development is a strategic priority that StandardAero is quite focused on, and these grow daily, as well as the aforementioned insourcing effort, where more repairs are being done in-house than sent outside. Good for CRS and good for the engine services business. And finally, we continue to pursue accretive M&A. Many opportunities exist for us, in particular in the fragmented CRS end markets, as represented by the ATI acquisition recently discussed. And we have ample balance sheet capacity, with now our leverage ratio just cracking under the 3 level at 2.99. We guided to strong revenue growth for the full year, now 12 to 15% revenue growth on the top line and 19 to 22% growth in adjusted EBITDA. Free cash flow growth at $155 to $175 million. And we have strong underlying demand in our end markets. Commercial aerospace, we're guiding you to mid-teens growth in commercial aerospace, high single-digit growth in the military business, and high single-digit growth in business aviation. This business through 2024 has grown an adjusted EBITDA CAGR of about 22%, and we expect this ratio to continue throughout 5 important key levers. First, strong market tailwinds, which have not changed. Secondly, harvesting our recent investments, in particular on the CFM56 expansion, doubling our capacity in Dallas-Fort Worth, and within CF34 and the important regional aircraft engine serviced out of Winnipeg with an expanded license agreement. Our performance excellence initiatives are right on track. This includes the expansion of CRS's margins, strong pricing levers, and other performance excellence initiatives. Our new platform wins, most significantly highlighted by the LEAP platform, where we are one of only 6 CBSA license holders. This is the highest level of license offered by CFM on this program, and the LEAP program is expected to be the largest engine program in the history of aerospace. And of course, continued M&A, a strong pipeline of available targets, as defined again by Aeroturbine just this last year. And M&A offers us the ability to add additional customers and additional platforms. In summary, we are a steady, boring, double-digit earnings compounder with multiple high ROIC capital deployment opportunities. Thank you very much, and we're open for questions.
Great. That was a great overview. Thank you, Dan. Maybe just to start, I just wanted to touch again on platform agnostic. You know, how has that been an advantage to StandardAero?
So we do. Is this on? Hello? Yeah, we provide services across 40 platforms today. That makes us quite unique. We are not only focused on one platform as some of our competitors are. And this balanced portfolio is very important to StandardAero, in particular during times of economic cycles. For example, during COVID, where total aftermarket spend in the industry declined by 41%, StandardAero's revenues only declined 16%. And that's due to the balanced portfolio that we have across many, many platforms. In particular, government spending remained strong during 2020 and 2021, and business aviation famously went down and rebounded quickly as people moved to private aircraft transport. And on the commercial aerospace engines, we are on the important narrow-body engines that continue to fly during that economic cycle. Similarly, during 2008 great economic recession, StandardAero's revenues only declined 6%, all for the same reasons.
Wow, that's...
Yeah, sorry, one thing I'd probably add to that is just the use of the word agnostic, maybe not intended in this circumstance, but from a platform perspective, we obviously study hard the markets that we serve, right? And any markets that we invest in, platform by platform, you know, we look at the aircraft that the engine powers, the engine itself, who the operators are, the geography of the operations. So we study very hard the platforms that and the markets that we participate in. So we're definitely not agnostic to the platforms that we serve.
Could you maybe just provide a little more color on what's the process like to win one of these, you know, MRO contracts for maybe something big like LEAP? I mean, what are the dynamics at play there?
Sure. So LEAP's a great example. You know, the how we win piece of that is decades-long relationships with the OEMs. You know, we have constant interaction with the OEMs about when, you know, how their network, the vision for how their network's going to shape out. And, you know, we're right there on, you know, the job is to be the first on the list when it's time to run an RFP. We have the infrastructure to industrialize, so we have the buildings, the management infrastructure, the test cells. More importantly, Dan talked about having 55 test cells. It takes years and tens of millions of dollars to build a test cell. So if you can show an OEM, there's my test cell, right? That's where we will test your engine. That your P-win goes up substantially. We also have a global sales force, and we have a bid development team internally that can interface directly with the airlines. When the airlines put out RFPs, we can bid their requirements. We can cover the globe with our sales force. So we have access to the entire world of, in this example, LEAP operators, which is very important on the LEAP because they are an open network. So the OEM isn't out there owning the aftermarket, selling their deal structures and underwriting them, then allocating the work to the different shops. They depend on the 6 CBSAs in the case of the LEAP to go out and sell and win in the marketplace and satisfy the airlines directly. So that's a big criteria for us as to how we win. And importantly, all of that is kind of part of being a big, credible organization that is allegiant to the OEM. So we do things their way, process-wise. We consume their parts. Dan mentioned, we're the channel through which they sell parts, and that's how OEMs make money in the aftermarket. So that's the how we win part. The process part is, it's an RFP where you're competing with multiple other MRO providers, much like us. There aren't a lot of independent MROs that look like us, right, with all of those kind of how we win criteria I mentioned. So it whittles down to a pretty small group pretty quickly, and you mostly see that reflected in who the other 5 CBSA license holders are, including us.
Excellent. That's a great overview. Maybe just focusing in more on LEAP, just given the size of that opportunity, could you talk maybe about when you see CFM 56 kind of peaking out, and when you're going to expect a normalized LEAP repair cycle?
So I'll start. Dan, you can jump in. For us, the CFM 56, we perform those services in Winnipeg historically, as well as now at our DFW site. We've stood up the LEAP program in San Antonio, so there's no kind of conflict there, right, operationally or footprint-wise, between how, what we prefer to work on. We prefer, both markets to do well, and they're deconflicted by being worked in different sites. So CFM 56, we don't see it too much differently than the OEM. I think we're tracking with them where, it's going to peak sometime in 27-ish. Maybe next year, maybe 28. It just kind of depends. It's a moving target, but we're still working our way towards peak. Still 40% of CFM 56 engines have not seen their first shop visit. So there's a lot of work out there to be done, and we see it in the pipeline, right? As we've added capacity, and we're one of the only ones we can think of that have added substantial capacity in this marketplace. We see the pipeline of opportunities, and we're out there winning work. And so CFM 56 will peak, and then it's a workhorse of the fleet, so it'll sort of plateau later in the decade, we suspect, and then start to soft land over time in the 2030s and 40s. So it's a long-term investment, and we see a lot of runway on the CFM 56. Meanwhile, the LEAP market, right, it's been in service since 2016. It is a hockey stick in terms of MRO growth. It's a huge growing market, especially for MRO, as the MRO work starts to sort of come off of what's been out there delivered and in service over the last 9 years, and as well as the embedded base that is growing with deliveries, especially as Boeing and Airbus start to ramp more. So we perform services on the 1A and the 1B. The 1A is the Airbus product. The 1B is the Boeing product. The LEAP has, over the last several years, been winning 70% of the A320 campaigns, and they get 100% of the Boeing MAX engine installed base. So So the LEAP is just a huge program, and you know, we see the MRO requirements coming through the pipeline, and it's reflected in our win rate.
Yeah, we've talked about LEAP. You know, it's a 30-year license, and it's going to eclipse the CFM56 as the largest engine platform in the world. Our entitlement over that 30 years is approximately $60 billion of revenue. So LEAP is going to be, you know, obviously very important for StandardAero going forward. We've talked about it reaching sort of a steady state, you know, $1 billion level of revenue annually at the end of this decade.
Wow. So, I mean, huge opportunity with LEAP, but also, you know, engines are staying on wings longer now. Planes are getting older. What has that meant for StandardAero in the last couple of years?
Well, so more aftermarket work to do, right? That's why we invested in the CFM56 capability in Dallas. You know, I'd say another benefit of the CFM56 site in Dallas is it allows us to shift capacity around where demand surges. So CFM56 in Winnipeg also shares a facility with the CF34 program, which is huge, right? I mean, it powers the aircraft around which U.S. Airlines pilot scope clauses were written, 76-seat aircraft. So that's and it's still in production, still being delivered, still being ordered by the big regional carriers. So the CF34 program is huge, and we have a leadership position, we have for a long time in that market space, and we recently reinvested in that as well. So what the Dallas site allows us to do is avoid spilling demand on CF34 and CFM56 by just pushing CFM56 work down to Dallas if Winnipeg needs capacity for CF34, right? So it's the Dallas site is a real benefit for both CFM56 and CF34, two of our biggest and highest growth programs.
Excellent. And I'd like to touch on the synergies you see between the CRS segment and engine repair. Maybe you could talk more about the opportunity there.
Yeah, I mean, you know, we talked about the acquisition track that we've been on with 11 acquisitions in the last several years. Most of those acquisitions have been in the CRS space. Interestingly, CRS now with our guided revenue in the mid $700 million range has grown from, you know, a $100 million business just a few years ago. And this expansion in particular has been around new capabilities, new repairs. It's quite unique that you can come to one service provider such as StandardAero and get almost your entire suite of repairs done by one service provider. That speeds turnaround times. Turnaround times is likely the most important metric for any aircraft operator. These are revenue generating assets. The faster that aircraft is flying again, of course, means more revenue and lower downtime. So as the component repair services segment has expanded its repair portfolio, it now can provide those same suite of services not only to third parties, and in some cases our competitors, but also the internal engine shops of StandardAero. And so we call that the insourcing initiative, which has been wildly successful. It already has grown 40% year over year. Repairs done now internally as opposed to third party, and of course at cost. So that synergy is really realizing itself. It's allowing the CRS segment to grow even faster and providing services back to their sister divisions.
One other synergy opportunity there is with respect to new platforms. So when we're looking at a LEAP, right, or any new platform, it's an investment case, right? There's CapEx on the front end, and then there's, you know, kind of startup losses as you're moving down the learning curve, and so you're investing in a long-term opportunity. One of the things that really bolsters the investment case is that CRS element, because with that internal capability, either we have the repairs or we can develop those repairs. We know we can bank that profitability, that high profit margin portion of the engine overhaul. We know we can bank that as staying inside the family, and that's a huge benefit to the business case, as well as being able to take those same capabilities and sell those to third-party participants in the market as well.
Excellent. Pivoting to the defense side, we've spoken primarily on commercial. Maybe what's the opportunity there, and what are the key platforms?
Yeah, we're on the right platforms, the ones you want to be on, that are really unimpacted by any sort of government spending reductions if, you know, if they were to be in place, and as represented by the C-130, for example. That is again, the transport cargo aircraft for personnel and material, and these fly regardless of whether there's a conflict or not. And those programs don't get cut. Also, the V-22. The V-22, of course, is the tilt rotor aircraft that flies the cargo transport of material and people for the U.S. Marine Corps. There is no replacement for that aircraft in any sort of long-term timeline, and we hold the leading position there. That program doesn't get cut. And again, there's other platforms, but also the J-85. Just recently in San Antonio, the Secretary of the Air Force visited our facility and said, StandardAero, we need more pilots trained. I need over 300 pilots, additional pilots trained, so I need more J-85s. As a result, we put in additional capability, additional focus on the J-85, and are doing exactly that for the Air Force. Plus now with the acquisition of ATI, which also serves the J-85 platform, we've now expanded our capabilities on 3 programs that are very solid for the U.S. military. Plus, the government wants us to win. They see StandardAero as a trusted provider for mission readiness, and they're typically rooting for us to get more business on these key platforms. So there's lots of opportunities for us in the military in the future.
I'd like to just turn to the audience if there's any questions. Okay, well, I have a few more here. Maybe just as it relates to predictive maintenance and you know, understanding when an engine may be coming in for a shop visit and what may need to be done. I guess how does that play into what StandardAero does?
Sure. We, you know, I think if you look at it, right, there will only be more opportunity on predictive analytics just because the newer gen engines are built with more sensors on them to collect data while it's operating and feed it back in. So a lot of opportunity with next-gen engines. But as we sit here today, we have a couple products that support services to certain customers in the commercial and military end markets that take that operator's data set, which is not worth a ton, without a system to intake it and then output recommendations and solutions, right? So we have the system that will import that data and output operational recommendations to the customer. You know, things like where should you stage this engine? How much time should you build into this engine, right? It's pretty specific. And you know, for the military particularly, right, the geography matters because they stage assets in theater in different places. So this becomes pretty important. That's one area where we are engaging with customers on predictive analytics. Another, not necessarily engine health predictive analytics, but more on the sales side, is we utilize our CRM system pretty extensively to be proactive about selling, most notably in the business aviation market. So we take, we have every engine serial number for every engine platform that we perform services on, even if we don't have them under contract. And we feed that system data, which you can get from third parties on flight cycles and flight operations for the different operators operating those engines, and out comes, you know, conclusions on, okay, this engine's going to need to be serviced in 5 months. And, you know, it's not a perfect sort of conclusion, but it allows us to go to the customer proactively and say, hey, look, you know, our system is telling us that your engine's going to need service in 5 months. Is that true? Maybe it's 7 months, right? Maybe it's 3 months. Are you know, would you like to book a slot? Because, you know, we're pretty far booked out. We want to make sure that we can service your engine when the service is required, and then you're not waiting in line. And so it allows us to be very proactive about engaging with customers and ultimately capturing that business.
Yeah, we're very, very close to our customers. These are multi-decade relationships, not only with the OEs, but with the customers. If you think about on the commercial aerospace side, we talked about earlier providing customized solutions. So if a customer is flying over salt water or over sand, we provide that customer that bespoke maintenance schedule for them. As a result, that stickiness with them and the understanding of their flight profiles is very important. Alex talked about the relationship with the business aviation, which is down to the serial number. And on military, these are, of course, long-term relationships that we've built with the U.S. military and understanding their mission readiness requirements. That's what makes us unique as an independent. We will provide customized service solutions to you that other MRO providers cannot. If they're related to, affiliated with an airline or even the OEMs themselves, you're going to get more off-the-shelf type repair portfolios. With us, it's customized and bespoke.
Excellent. Well, thank you for a great presentation and chat today, and we look forward to having you guys back next year, so thank you very much.
Great, thank you.
Tony Bancroft is a portfolio manager for Gabelli Commercial Aerospace and Defense ETF. Michael Bergio and Daniel Gleam are research analysts at Gabelli Funds. The above webcast is a recording from the 31st Annual Gabelli Aerospace and Defense Symposium, which occurred on September 4, 2025. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of June 30, 2025, affiliates of GAMCO Investors Incorporated beneficially owned 5.61% of Abdu Koman, 2.98% of Graham Corporation, 2.41% of Astronics Class A and less than 1% of Class B, 2.37% of Moog Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 355 914 921 5100 fax 914 921 5118 info@gabelli.com. Tony Bancroft is a portfolio manager for the Gabelli Commercial Aerospace and Defense Fund. This ETF is different from traditional ETFs. Unlike traditional ETFs, this ETF will not tell the public what assets they hold each day. This may create additional risks for your investment. For example, you may have to pay more money to trade the ETF shares. This ETF will provide less information to traders, who tend to charge more for trades when they have less information. The price you pay to buy ETF shares on an exchange may not match the value of the ETF's portfolio. The same is true when you sell shares. These price differences may be greater for this ETF compared to other ETFs because it provides less information to traders. These additional risks may be even greater in bad or uncertain market conditions. The differences between this ETF and other ETFs may also have advantages. By keeping certain information about the ETF secret, this ETF may face less risk that other traders can predict or copy its investment strategy. This may improve the ETF's performance if other traders are able to copy or predict an ETF's investment strategy. However, this may hurt the ETF's performance. For additional information regarding the unique attributes and risks of this ETF, see the Non-Transparent Exchange Traded Fund (ETF) Structure Risk, Early Close/Trading Halt Risk, and Authorized Participant and AP Representative Concentration Risk in the Principal Risks section of the prospectus. Exchange-traded funds (ETFs) are bought and sold through exchanges trading at market price, not NAV, and are not individually redeemed from the fund. Shares may trade at a premium or a discount to their NAV in the secondary market. There is no guarantee the investment strategy will be successful. Investing involves risk, including the possible loss of principal. Premiums or discounts are the differences, expressed as a percentage, between the NAV and market price of an ETF on a given day, generally at the time the NAV is calculated. A premium is the amount an ETF is trading above the reported NAV, expressed as a percentage of the NAV. A discount is the amount an ETF is trading below the reported NAV, expressed as a percentage of the NAV. The prospectus/registration statement shows the frequency of distributions of premiums and discounts for these ETFs for the most recently completed fiscal calendar year and all completed quarters of the current fiscal year. Investors should carefully consider the investment objectives, risks, charges and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes. As of June 30, 2025, the common stocks of Boeing, Ducommun, Curtiss-Wright, Moog, 5.55%, 4.54%, 4.26%, 3.69% of the fund's net assets, respectively. As of June 30, 2025, affiliates of Gamco Investors Incorporated beneficially owned 5.61% of Ducommun, 2.98% of Graham Corporation, 2.41% of Astronautics Class A and less than 1% of Class B, 2.37% of Moog, Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. Distributed by G. Distributors, LLC, a registered broker-dealer and member of FINRA.